People ask me all the time, which stocks should I buy? But when we pick individual stocks, the question when is extremely important. In fact, it's even more important. Because there are many great companies that I would like to own, but I don't buy them because they are not undervalued. There's a theory called the efficient market hypothesis. The theory says that since every investor can reach every data about the companies, stock prices always reflect the real value of the companies. But this is not what we see in reality. Most of the time, investors price the stock in a way the price reflects the real value of the company. Most of the time, but not always. We can find a lot of proof of why the market is not always efficient. I bought Whirlpool at $91 and 1 year later I have a 154% capital gain on it. Did the company grow its revenue 154% in a year? No, it didn't. I only have a huge capital gain on it because I bought the stock when it was undervalued. Because at that time, investors didn't price the stock properly. I bought the stock of BlackRock at $400 and now, 1 year later, I doubled my money because the stock price today is close to $800. Did BlackRock double its revenue in 1 year? No, it didn't. I only have a huge capital gain on it because I bought the stock when it was undervalued, when the market was not efficient. Last year, in February 2020, when they introduced the virus in the news, the stock market, the S&P 500 dropped 31% from its top only in 4 weeks. Just 6 months later, the prices were back at the same level as they were before the virus. So does this mean that the 500 biggest companies lost 31% of their revenue in only 4 weeks? Even if they had lost their revenue, we wouldn't know about it until April, because companies only give reports after each quarter. So investors didn't know about any revenue loss, yet they sold their stocks, and 6 months later they bought back everything. Of course, we can argue that the sellers and the buyers were not the same people in this case, but we are talking about all the investors collectively, as this is the point of the efficient markets theory. So it's very obvious that the market not always efficient because investors are just people, and we know that people do not always act rationally, to say the least. And this means that there are occasions when we can buy stocks cheaper than their real value. And there are companies that I would really like to own, like for example Apple, but they are very much overvalued today, so I don't buy them. But you need to be aware that the stock price does not reflect the valuation. Sometimes people tell me, this and that stock dropped 10% from its top, so should I buy it now? You cannot evaluate a stock by looking at the price chart. The price of the stock or the price chart doesn't tell you anything about the real value of the company. If Tesla would drop 50% today, the stock would be still extremely overvalued. Take a look at this illustration. This is an oversimplified illustration of the margin of safety. The red line is the real value of the company, as we know that companies are growing in general. Of course, this is an ideal situation. Now the wavy black line is the price of the stock. This is what we usually see on a chart, right? As you can see, the price of the stock doesn't always reflect the real value. Sometimes it's overpriced, sometimes it's undervalued. But over the long term, the price can't differ from the real value. So over the long term, the price will always follow the real value of the company. And there are two reasons why we should buy stocks with a margin of safety. Reason number one, if something goes wrong, I still make money. First of all, this illustration shows an ideal scenario where the company grows as it's expected. But nobody knows the future, and no matter how good investors we are, there will be occasions when we pick a stock that will fail. For example, when the revenue of a company is going down and they have to cut the dividend. In these cases, the margin of safety minimizes our risk. In 2018, I bought the stock of L Brands. This is a fashion retail company. They own the brand Victoria's Secret. I bought the stock when I believed the stock was undervalued. Keep in mind that this company was growing their dividends for 16 years in a row. They never cut the dividends. So I bought the stock, but a few months later the company cut its dividends. This is because the revenues of the company were going down. Needless to say, the stock plummeted. Investors don't like it when companies cut their dividends, so they sell the stock and the price goes down. And needless to say, I don't want to own companies that can't keep growing their dividends. But since I bought the company with a margin of safety, when the stock plummeted, I could still sell it with a 20% capital gain on it. So this is the first reason for buying stocks with a margin of safety. Even if things go wrong, we can still make money. Or in other words, the margin of safety minimizes our risk. If you buy a stock when it's not undervalued, if anything goes wrong, you will suffer a much higher loss when the price plummets. Reason number two, if everything goes well, I will have a higher return. So the second reason for buying stocks with a margin of safety is that we can make higher returns on our investments. I bought Whirlpool when the price of the stock was around $91. Today, only 1 year later, I have a 154% capital gain on it. This is because I bought the company when it was undervalued, with a margin of safety. So if anything goes wrong, and let's say Whirlpool drops 50% in price, I will still make money on it because I bought it at an even cheaper price. And if everything goes well, I will have a much higher return on my investment because I bought it cheaper than the normal value of the company. Not to mention, I also get dividends while I hold the stock. So when we buy a stock with a margin of safety, we speculate on the fact that over the long term, stock prices usually go back to normal valuations. And in a worst case scenario, we don't lose that much money on it, or we even make money on it, even if something goes wrong.